In the world of trading, the difference between success and failure isn't always about the strategies or the numbers. No, the true battle is fought inside your own mind. It is an internal war, a test of emotional strength, where every decision can either propel you to victory or drag you into the depths of defeat. What sets successful traders apart from those who lose their way in the markets isn't just the ability to read charts or interpret market movements, it's their emotional discipline. The ability to suppress the impulses of fear and hope, to act with unwavering precision, and to stay true to a well-laid plan in the face of market chaos is what separates the elite from the average. At the heart of this battle lies one of the most dangerous emotions of all: hope. The dangers of hope in trading. Hope is a silent killer, an emotion that creeps into the trader's mind with the subtlety of a whisper. It tells you that things will turn around, that this losing position will recover, and that all is not lost. Hope is seductive, convincing you to hold on for just a little longer, to wait for the market to give you the bounce you've been praying for. But here's the truth. Hope is not a strategy. In fact, it is the antithesis of strategy. Hope is the very thing that stops you from making the disciplined, logical decisions that are required in the market. It leads to inaction when you should cut your losses, and it keeps you in positions that are destined to fail. When you let hope dictate your actions, you lose sight of the objective reality of the market. Instead of analyzing price movements and patterns, you rely on the belief that things will improve on their own. This often results in small, manageable losses, turning into catastrophic declines. I've seen it happen countless times. Traders who are so gripped by hope that they hold on to a losing position far beyond the point of reason. They hope and hope and hope until their accounts are drained. Hope has no place in trading. The market doesn't care about your hopes, dreams, or aspirations. It is a cold, impersonal entity that is driven by supply and demand. When you cling to hope, you are fighting an enemy that feels no emotion and is unaffected by your personal beliefs. Fear, a paralyzing force. While hope can trap you in a losing trade, fear can paralyze you from making any decision at all. Fear is another deadly emotion in the world of trading, and it comes in many forms. One of the most common is the fear of missing out, or FOMO. This is when you see a stock rising and you're afraid of not being part of the movement. It compels you to jump into a trade too late after most of the profits have already been made, only to see the market reverse sharply against you. But fear also takes other forms. The fear of taking a small loss can prevent you from exiting a failing trade at the right time. Instead of cutting your losses and moving on, you hold on to a position in the hope that it will turn around, which often only leads to even greater losses. Similarly, the fear of losing profits can make you exit a winning position prematurely, leaving significant gains on the table because you're afraid the market might reverse. Fear distorts your judgment. It turns clear, objective signals into confusing noise and makes you question every decision you've made. It robs you of the ability to act decisively when the moment calls for it, and it forces you to make impulsive, emotionally charged decisions that have no place in a sound trading strategy. The key to overcoming emotions. To succeed as a trader, you must develop a level of emotional detachment. The market is not swayed by your feelings. It doesn't care if you're scared or if you're hopeful. It simply reacts to the forces of supply and demand. The sooner you can understand this, the better prepared you will be to make objective, data-driven decisions. You must train yourself to separate your emotions from your trading actions. This doesn't mean you become heartless or indifferent to the outcomes of your trades. It simply means that you approach each decision with a clear, focused mind, free from the distortion of hope or fear. The market will never respond to your feelings. It doesn't care if you're terrified of missing out on the next big move, nor does it care if you're hoping that a losing position will come back. It responds only to the impersonal forces of buying and selling, to the momentum of the market, and to the collective actions of all participants. To navigate this cold, indifferent world, you must adopt a mindset of objective observation. This is the first step towards achieving clarity in your trading. It's about learning to observe price movements and market behavior without letting your emotions cloud your judgment. Developing objective observation. What does it mean to observe the market objectively? It means watching the price action without projecting your hopes, fears, or desires onto it. When you watch the charts, look for patterns, look for trends. Pay attention to the volume and the movements, not to the internal narrative that your emotions are trying to spin. It's about letting the market speak for itself. The price movements are telling you a story, but only if you are willing to listen with a clear mind. To truly develop this skill, you need to learn to suppress your personal opinions. You need to silence the emotional chatter that is constantly running through your head. It's not easy, but it is the key to trading with clarity and precision. Remember, the market doesn't care about your internal dialogue. It doesn't matter if you want a position to go in your favor or if you're terrified of losing money. What matters is what the price is doing right now and your ability to respond to it without bias. The power of a well-defined trading plan. One of the best ways to avoid emotional decision-making is to have a clear, well-defined trading plan. This plan should outline every aspect of your trading strategy, your entry and exit criteria, your risk parameters, your capital allocation, and your approach to both cutting losses and taking profits. When you have a set of rules for every situation, you remove the need to make emotional decisions on the spot. Your trading plan becomes your shield against the destructive forces of hope and fear. It serves as a guide that helps you navigate the chaos of the market with confidence and discipline. Having a plan in place allows you to make decisions based on data, logic, and strategy, not on how you feel in the moment. It removes the guesswork, and it ensures that you're not swayed by emotions like hope or fear. The discipline of cutting losses. One of the most important rules in trading is to cut your losses quickly. This is where many traders fail. They hold on to losing positions for too long, hoping that the market will turn around, only to watch their losses grow. The key to avoiding this is to have a stop loss in place and to honor it without hesitation. When your stop loss is triggered, you exit the trade, no questions asked. This is the point where hope must die. Hope tells you to hold on, that things will get better, that the market will turn around. But the reality is that the market often doesn't care about your hopes. If the trade is going against you, it's better to accept the loss and move on than to keep fighting a battle you can't win. By cutting losses early, you minimize the damage and protect your capital. This discipline is vital for long-term success in the markets. If you allow hope to dictate your actions, you'll find yourself in a never-ending cycle of losses that will eventually drain your account. In the world of trading, it is not enough to simply survive. The goal is to thrive. But to thrive, you must operate at your best, consistently and without hesitation, following a clear set of rules that allow you to make decisions with precision. To do this, you must embrace two key principles: discipline and detachment. Discipline, the cornerstone of consistency. Discipline is the cornerstone of any successful trading strategy. Without discipline, you are simply reacting to the market based on emotions, which leads to erratic decisions and inconsistent results. Emotional traders are often swayed by the highs and lows of the market, jumping into trades based on impulse, fear, or greed. To combat this, you need to commit to your plan and execute it without deviation. You need to have rules in place that define how you will enter and exit trades, how much risk you are willing to take, and what your criteria for success and failure are. This is the structure that keeps you grounded when the market throws its inevitable volatility your way. When you commit to a disciplined approach, you are no longer at the mercy of the market's fluctuations. Instead, you are guiding your actions with clarity and certainty, understanding that every trade is a part of a larger picture. Embracing detachment. Alongside discipline, detachment is equally essential. The detachment I speak of is not about becoming numb to the ups and downs of the market. It's about treating each trade as a statistical event, a single data point in the vast ocean of trades you will make over your career. Each trade is not a reflection of your personal success or failure, but merely part of the larger process. This approach allows you to remove your personal emotions from the equation. You are no longer emotionally attached to any particular trade. When you cut a losing position, it's not a personal failure. It's simply part of the game. When you take profits, it's not a triumph to be celebrated too much. It's a natural outcome of following your rules. By cultivating this detachment, you make decisions based on logic, not emotions. You allow the market to behave as it will, and you respond accordingly, without fear, hope, or greed clouding your judgment. This is where true mental fortitude comes into play. It is easy to trade when things are going your way, but the real test of your skills and your emotional strength is how you behave when the market isn't in your favor. The rule of cutting losses. When it comes to cutting losses, swift action is your best friend. In fact, the faster you can cut a loss, the smaller it will be. This is a crucial concept in trading psychology. Many traders try to justify staying in a losing position by hoping for a turnaround. But hope is an unreliable strategy. In reality, every trader must accept that losses are inevitable. No matter how perfect your strategy is, you will face losses. The key is not to avoid losses, but to manage them effectively. By cutting them early and decisively, you prevent them from growing into something far worse. To help implement this, make sure that every trade has a predetermined stop loss. This is a price level at which you will exit the trade if things are not going in your favor. It's essential that you honor your stop loss, no matter how uncomfortable it may feel. The discomfort is simply a sign that you're doing the right thing. The importance of consistency. In the world of trading, consistency is the key to success. Consistency doesn't come from making big wins. It comes from making consistent, disciplined decisions over time. Small, controlled losses and carefully executed wins will accumulate into long-term success. One of the mistakes I often see new traders make is trying to make big, risky bets in the hopes of fast profits. But this strategy often leads to equally big losses. Instead of aiming for a single massive win, focus on accumulating smaller wins that add up over time. This consistency requires you to follow your plan, day in and day out, even when the market feels unpredictable. Over time, this consistency builds the necessary foundation for sustained profits and financial growth. The dangers of overtrading. Another key to maintaining discipline and emotional detachment is to avoid overtrading. Overtrading occurs when traders, driven by emotion, make too many trades without following their strategy. This often leads to poor decision-making and impulsive actions. In a market driven by emotional reactions, the temptation to overtrade is ever present. You may feel the need to do something because the market is moving, but in reality, waiting for the right opportunity is often the most disciplined action. Traders who overtrade tend to lose focus and become more prone to making emotional decisions, ultimately leading to poor performance and increased risk. This is why detachment is so important. By taking a step back and focusing on your rules, you avoid the urge to act out of emotion. The mental models of trading. As you become more seasoned in trading, you'll begin to develop what I call mental models, frameworks for understanding the market and making decisions that are based on logic and objectivity. These models come from years of experience, trial and error, and the discipline to follow the rules you've set for yourself. One of the most important mental models is to view each trade as a probability event, not as a guaranteed outcome. This mindset allows you to accept the inherent uncertainty of trading, knowing that some trades will work out and others won't. It also prevents you from becoming emotionally invested in any single trade, as you understand that each trade is just part of the process. By embracing the idea of probability, you also embrace the reality that no matter how good your plan is, you cannot control the outcome of each individual trade. What you can control is your behavior and your discipline. The better you execute your plan, the more likely you are to experience success in the long run. Greed and the illusion of easy money. Greed is another emotion that can havoc on your trading results. Greed is a subtle emotion that often takes root after a few successful trades. When you experience a win, you start to believe that the market will continue to provide easy profits. This leads to taking on too much risk or holding on to positions longer than you should, hoping for that extra gain. But greed blinds you to reality. It makes you overestimate your abilities and the predictability of the market. Greed often leads to over-leveraging your trades, taking on too much risk, and abandoning your risk management strategies. In the end, greed can lead to catastrophic losses. Controlling greed. To control greed, you must follow the same discipline and detachment principles that you apply to other emotions. Your trading plan must include clear exit points for profits, and you should honor these points without hesitation. When you reach your target, it's time to exit the position, even if it feels like there is more to gain. By sticking to your profit-taking rules, you avoid the temptation to overstay your welcome in a winning trade, which often leads to giving back all of your gains. The art of patience. Perhaps the most underrated trait of successful traders is patience. Patience is what allows you to wait for the market to give you a signal that aligns with your strategy, instead of forcing a trade when the timing is wrong. Successful traders don't chase the market. They wait for it to come to them. By exercising patience, you allow the market to give you clear signals, and when those signals appear, you execute your plan with precision. This is where detachment plays a key role, waiting for the market to show you the right opportunity and then acting without hesitation, free from the emotions of fear or hope.
Mastering the markets with unwavering precision. At this stage in your journey, you have developed the understanding that trading isn't about luck or intuition. It's a battle of emotional control, logical decision-making, and unwavering discipline. In the next phase of your evolution as a trader, you must take these lessons even further. You need to master the ability to respond to the market with precision and to stay the course even when volatility is high and external pressures are mounting. The importance of a well-defined strategy. A crucial part of becoming an elite trader is building a well-defined strategy, one that you can rely on no matter the circumstances. Without a solid plan in place, you will find yourself in reactive mode, constantly jumping from one idea to the next, never fully committing to a strategy. Your strategy must encompass every aspect of your trading: entry points, exit points, risk tolerance, position sizes, and capital allocation. It's your roadmap, guiding you through the emotional highs and lows, ensuring you never stray too far from your purpose. A well-defined strategy is what separates professional traders from amateurs. Think of your trading plan as a set of rules, rules that remove emotion from the equation. By adhering to your strategy, you can avoid the temptation to chase the market, hold on to losing positions, or take profits too early. A disciplined adherence to these rules creates consistency, and consistency is what wins in the long run. Building the right mental framework. To fully embrace your trading strategy, you need to build the right mental framework. This means developing the mindset that your trading decisions should be based on objective analysis rather than fleeting emotions. Your mental framework should include detachment. As mentioned before, you must emotionally detach yourself from the outcomes of individual trades. It's essential to see every trade as part of a larger system, not as a personal win or loss. This helps to prevent you from taking unnecessary risks or holding on to losing positions or taking profits too early. Patience. Patience is one of the hardest but most rewarding traits a trader can cultivate. Waiting for the market to present you with an ideal setup is critical. Rather than forcing trades, you should wait for clear signals that align with your plan. It may feel frustrating at times, but patience allows you to capitalize on the best opportunities. Resilience. Trading can be mentally exhausting, especially after a series of losses. You must develop the resilience to bounce back quickly. A bad trade doesn't define your career. Instead, it's an opportunity to learn, refine your approach, and come back stronger. When you commit to developing these attributes, you begin to change the way you perceive the market and your role within it. Instead of fighting against the market, you become an observer, responding to its movements with precision and detachment. The emotional roller coaster, recognizing triggers. No matter how disciplined you are, the emotional roller coaster of trading is inevitable. The key is recognizing your emotional triggers and knowing how to respond to them before they take over. Fear of missing out, FOMO. FOMO can drive you to make impulsive decisions, especially when you see others profiting from a stock move. This can cause you to jump into trades too late or take risks that don't fit your strategy. The cure for FOMO is patience. If you miss a move, there will always be others. Don't chase a move out of desperation. Stick to your plan. Overconfidence. After a winning streak, it's easy to become overconfident. Overconfidence can lead to taking on more risk than you should, thinking that you have the market figured out. This is a dangerous mindset, as the market is unpredictable and will quickly humble you. Stay humble, stick to your plan, and respect the market's power. Regret and revenge trading. After a loss, some traders experience intense regret and may resort to revenge trading, attempting to win back their losses by taking overly aggressive trades. This is a dangerous cycle that only increases the likelihood of further losses. The antidote to regret is acceptance. Losses are part of the game. Accept them, learn from them, and move forward. The ability to recognize and manage these emotional triggers is one of the key aspects of becoming a truly disciplined trader. Once you can detach from the emotional extremes of trading, you will be able to make decisions with clarity and confidence without being swayed by feelings of fear or hope. The power of risk management. Trading without proper risk management is like driving a car without brakes. You might be able to go fast for a while, but eventually you'll crash. Risk management is the safety net that prevents you from losing everything in one bad trade. One of the first rules of risk management is never to risk more than a small percentage of your capital on a single trade. Many professionals recommend risking no more than 1 to 2% of your total capital on each trade. This ensures that even if you experience a losing streak, your account will still have enough capital to recover. Additionally, you must define your risk-reward ratio before entering a trade. For example, if you are willing to risk $100, make sure your potential reward is at least $200. This way, even if you lose half of your trades, you can still be profitable in the long run. Having a strict risk management strategy in place ensures that you don't let your emotions take control when you're in a losing position. Instead of holding on out of hope, you'll be able to cut your losses quickly and move on to the next opportunity. The importance of constant evaluation and adaptation. The market is always changing. What works today may not work tomorrow. Constant evaluation and adaptation are crucial for maintaining long-term success. As a trader, you need to regularly assess your performance, review your trades, and adjust your strategy as needed. This process of self-reflection will help you identify areas of improvement and understand the weaknesses in your approach. Perhaps there are certain patterns or mistakes that you tend to repeat, or maybe there are certain market conditions that trip you up. By recognizing these patterns, you can adjust your strategy and improve over time. Additionally, staying updated with market news and changes in economic conditions is essential. A good trader is always learning and adapting. The more knowledge you have, the better equipped you are to make informed decisions. The ultimate goal: mastery through consistency. At the end of the day, the true goal of a trader is mastery. Mastery isn't about finding a quick shortcut to success. It's about developing the mental fortitude, emotional control, and discipline necessary to execute your strategy flawlessly, day in and day out. It's about consistency, being able to follow your plan, adjust when necessary, and execute without hesitation. With time, this consistency will lead to sustained success, and you will see the fruits of your labor. The road to mastery is long, and there will be setbacks along the way, but each setback is an opportunity to learn and grow. It's not about avoiding mistakes, it's about learning from them and using them as stepping stones to become a better trader.
Achieving consistency and longevity in the markets. Now that you've gained a deep understanding of discipline, detachment, and emotional control, the final step in your journey is achieving consistency in your trading. This is where you separate yourself from the crowd. While many traders may experience moments of success, only those who master consistency will continue to thrive long-term. Building a routine and tracking your performance. One of the best ways to ensure consistency is to establish a trading routine. Just like athletes who practice daily, successful traders need to follow a routine that keeps them sharp and focused. Your routine should include daily review. Start each trading day by reviewing the market conditions, the charts, and the news. This helps you set the tone for the day, get a clear sense of the market's direction, and prepare yourself mentally. Pre-market analysis. Before you even think about entering a trade, you should conduct a thorough analysis of the markets. Identify key support and resistance levels, as well as potential trade setups that align with your strategy. Post-market reflection. After the market closes, take time to review your trades. What worked well? What didn't? What can you improve next time? This reflection is crucial to your ongoing development as a trader. By following a routine, you stay focused on your goals, eliminate distractions, and stay true to your strategy. Tracking your performance is equally important. Keep a trading journal where you record all your trades, including the reasons for entering and exiting each position, as well as your emotional state at the time. This journal serves as a valuable tool for identifying patterns in your behavior and understanding where you need to improve. The importance of patience and long-term thinking. Trading is often portrayed as a quick way to make money, but the reality is that it requires patience and a long-term mindset. The most successful traders understand that it's not about making quick gains. Instead, it's about making consistent, thoughtful decisions that accumulate over time. When you focus on long-term success, you're not swayed by short-term fluctuations. You understand that there will be ups and downs and that every trade is a part of a bigger picture. This long-term perspective helps you stay grounded and avoid emotional reactions to market volatility. Avoiding the pitfalls of greed and overconfidence. When you experience a streak of success, it can be easy to become overconfident. You may start to believe that you have the market figured out and begin to take excessive risks. This is where greed sets in, and it can lead to devastating losses. Greed is one of the most dangerous emotions a trader can experience because it distorts judgment. It causes you to hold on to trades for too long, take on too much risk, or disregard your strategy in pursuit of higher profits. The key to overcoming greed is to stick to your rules, no matter how tempting it might be to break them. Remind yourself that the market is unpredictable and that no single trade should define your success. Letting go of perfectionism. Many traders fall into the trap of perfectionism. They believe that every trade must be perfect, every move calculated to the finest detail. But the truth is that no trader is perfect. There will be losses, there will be mistakes. What defines a successful trader is not how well they execute every trade, but how they handle the mistakes and how they learn from them. The goal isn't perfection, it's progress. Every trade, whether it results in a win or a loss, provides an opportunity for growth. The power of consistency in risk and reward. As you become more experienced, you'll begin to understand the importance of balancing risk and reward. A consistent approach to risk management is crucial to long-term success. By following a risk-to-reward ratio, you ensure that even if you experience a series of losses, the wins will still outweigh them. For example, if your risk-to-reward ratio is 1 to 2, meaning you're risking $100 to potentially make $200, you only need to win 1 out of every 3 trades to remain profitable. The more disciplined you are with your risk management, the more consistent your profits will become. This consistency is what will allow you to grow your account steadily over time, rather than gambling with your capital on every trade.